Tesla doesn't always play by the rules, and financially there are a whole lot of institutions that are sometimes rooting for their failure, or at least not rooting for their success. And one person who has been tracking it more closely than the rest of us, who actually has some sway, some influence, and knows some people in the rating agencies and whatnot, is Alexandra Mertz, who is joining us today to discuss all of the amazing developments that we've seen and that we'd like to see on the financial side. I'm Brian. Welcome to Futuraza. So Alexandra, for those who don't know, and if you're watching this, led a crusade last year before, to get
2 years,
Tesla's 2 years to get Tesla's credit rating upgraded. She knew people at the rating agencies that she could send a presentation to say, look, here are the facts, here are the real details. What are you doing? And we're going to start with that. Let me pull up this slide from what you have recently published. This is updated relative financial strength table.
Mm-hmm.
This is pretty important here. Kind of hard to see at this scale, but what are we looking at? Tell me what we're seeing here.
Yes, so this is the quarterly table I've been doing since 2021. So this must be, I don't know, 9th or 10th edition of them. I do them after the financials come out, about 6 weeks after the quarter ends, for the 30 largest companies in the world and for the 10 biggest car makers, if those companies are rated. Because there are some others in the top 30 and there are some other car makers, but they're not rated. So this whole table was intended initially in 2021 and 22 to shame the rating agencies, because it became so blatantly obvious, and it still is, that Tesla needed a higher rating. So at that moment when I initially did it, Tesla still had a junk rating. And then we name-shamed them for enough time. Thank you for your help then, Brian, because we were all pulling for this together. And in the end, we got them to rate them the lowest investment grade, which in the case of Moody's is Baa3, in the case of S&P is BBB. So this is still too low. And you see that actually in the Tesla line. So Tesla in this table of the first quarter of 2024 is the number 14 mega cap here. And at the very end of that line, you see in orange, so still on the lower end, the current ratings. Of all these 40 companies I name here, they are the third last or lowest ratings. Yet, as you can see, for all the main financials, the financial strength, and I know that because I worked in rating agencies for a total of 10 years, out of which 7 for Moody's, they have the best ratios, the best cash to debt ratio, the best debt to equity ratio, the best debt to EBITDA ratio, the best debt to revenue ratio. And then there's also Altman Z score, which is not a figure that the rating agencies take in place, but which is a very good indicator for companies that are close to bankruptcy. Altman Z, anything above 3 is good, the higher the better. And obviously Tesla still has a high number here. But Altman Z is also very much linked to the stock price. So for the moment, Tesla is only 9th best. We've had other quarters where we're second best or even best, but it all depends on how the stock market moves for Altman Z. So Altman Z is actually a better indicator for the lower quality stock, meaning those that are below 3 have to look out whether they're getting close to a financial weakness, and below 1.8 whether they're really in difficult territories. And if you scroll further down, if you don't mind, Brian, you actually see that the car makers in the lower side, they're all in the dark orange for the Altman Z, because they are really in trouble. And Renault is the highest trouble kit in that category, obviously backed by the French state. So at the moment they're not going bankrupt, but if they wouldn't be backed, they obviously would be very close to it. So all these numbers, I mean, you don't need to look at them in detail, but what is really important is Tesla has strong financials, and even though the stock price has been lower, it's not anymore. The last month has helped us a lot, but this one was done middle of May, this table, and will be done again middle of August. So we in a couple of weeks we'll see a much stronger table for Tesla again, because we're catching up in the stock price. And I also think we're actually catching up with the financials because we had 2 tough quarters with less free cash flow. So whilst it was getting more difficult for Tesla, actually they still don't need any debt, right? They have virtually no debt, and that's what gives them all this strength. So yes, what I did in 2022, and with the help obviously of X and my followers who pushed it, was shaming the rating agencies to finally take action to put them at the lowest investment grade. Well, that worked, but what didn't work is that I'd hoped that that would increase the number of the percentage of institutional investors, because institutional investors have for a long time said, okay, we would like to invest into Tesla, but it's junk rated, so our rules don't allow us. And in the end, that didn't prove true at all, because today we have about 40% of Tesla's investors who are institutionals, which is low. If you compare that to GM is over 80% institutionals, which is crazy, right? Which just shows how short-sighted these people are. But anyway, so the premise I had then, thinking it would bring us new institutional money, obviously coincided with a moment where economic weakness, delays with Tesla and all the rest, everything came together, and institutions obviously used those excuses to still stay out of Tesla. The good thing about it is that actually Tesla is today in an even stronger position, and they're still not here, which helped us for the vote, if I would want to talk about the vote, because I think it was important that we had such a high retail part to get that vote in for the proxy 2024.
Absolutely. Well, we will have a whole second part to this video where we tackle just the question of where is the institutional money and what on earth are you people thinking? But first, let's talk about, my first question would be, what should the rating be? It's at the very bottom edge. It is junk adjacent. What, based on your professional opinion, having worked in this industry, what would the rating be?
But it should be at least AA. Should be at least AA, but obviously Tesla is not playing this corporate game. Around the moment where it got upgraded, Tesla did reach out obviously to S&P, because S&P suddenly did a study for them for which they got paid. So they were for the first time playing a little bit that corporate game that brought that upgrade. But obviously since then Tesla is not playing that game, and I'm all for it. They should not play these games. This is borderline what this whole financial system at the moment, how it's built up. So I'm very happy that Tesla is not playing that game, and Tesla does not need to play that game because Tesla doesn't need to take out debt. Those ratings really help when you issue bonds, because the bond market is completely still manipulated by these ratings. Also the green bond market. But Tesla doesn't play in that game. They don't want to do that. They have a credit line if ever they need one. They have a 10 billion credit line with a couple of banks, as a syndicate of banks. So that's all in place. They still don't need it, but they certainly don't need to issue any further bonds. So it should be AA. But Tesla not playing the game, they're not going to give it easily. They want to see money flowing before they look at it in a more positive way. And so I guess we're just stuck at BBB at the moment.
Merely billions a quarter. I get it. I wouldn't trust them either. Come on, people. So with that, the S&P 500 inclusion, that took a long time. Now, I understand there are rules. You have to have consecutive quarters of profitability, but there are exceptions, and other companies have been allowed in prior to satisfying all the requirements. It was clear what was going on at Tesla. How did they miss this?
Well, not that they didn't miss it. They just delayed it as long as they could. And actually, at the moment, they're delaying another thing as long as they could. As you know, Tesla is part of the consumer discretionary basket. So why is that important? Because in lots of index funds, that means that Tesla has its certain weight, either because it's a factor of the S&P 500, we saw that rally in 2020, or because it is of the basket of consumer discretionary. So if somebody does a consumer discretionary fund, well, you'll have your X% Tesla in there. But we all know that Tesla is not a car company. Car companies go in, old style car companies go in the consumer discretionary basket. So at one moment, Tesla will have to move to tech. Right? I mean, it could move to energy as well, whatever. But the most logical, if all goes the way we think it should go, would be to move to tech. And you will see, and I understand why it's not moved yet. I completely understand that. But you will see that they will be the slowest to ever move there. Why? Because that move out of the consumer discretionary into the tech basket will be equivalent, if not more, than the S&P 500 inclusion. Why? Because the volume of index funds on tech is just monstrously bigger. So the moment that Tesla will finally officially move out of the consumer discretionary into the tech basket, in the way that the stock exchange classifies them, that will be a second S&P 500 moment. Will it come this year? Will it come next year? Will it come 2 years? I have no idea. But one thing I'm sure about is they're going to delay it again, like the S&P 500, as long as they can. So I've looked at the criteria for all that. I mean, at the moment, it's still justified, because at the moment, 90% of revenues are still car revenues, right? But we all know that is going to flip in the next 2 years. And we will have to put pressure again on them, because they're not going to give it to Tesla for easy, right? Easy and quick. But it's going to make a huge difference to the stock price. The moment that happens, that's going to be a huge accelerator.
That's all pretty crazy to think about. And I feel like, tell me if I'm crazy here, part of the reason they don't want to include it is because they know the stock will jump again. And
Yes,
they kind of don't want it to. They don't like it. It's too big already. The last thing we want to do is help them make it bigger for reasons that, whatever, because we're old school. I don't know. Was there any backlash to it finally being included? I know I'd heard people say, boy, if I was one of these fund managers, and it's not really a fund that you manage, but fund supervisors, I would feel annoyed that I didn't get to include it until after it had already done its big run up. Have you heard anything about that?
Yeah, well, it was technically difficult. It's easy when you have the typical S&P 500 and stock 499 gets in, right? It's usually a small stock. When Tesla moved in, it was in the top 10 already. So it was a huge stock to suddenly include. So if you were a fund manager that didn't have the S&P 500, that didn't have any Tesla yet and had to include it, it really made a big difference. And you had to sell the other 499 stock proportionally, a little bit of each, to include then Tesla. So that was, excuse me, I'm not going to feel sorry for them, but it was a huge job. And then you have different attitudes to that. You had banks and fund management companies that said, okay, we'll start doing that a week ahead of time and build it slowly up. Then you had others that said, okay, we'll do it on the last day only. And then you had some that said, well, we'll do it at the closing at 4 o'clock Eastern. When the stock exchange closes that day, we'll do it then. And that was obviously harsh, because that really meant you had that afternoon all the adjustments to make, because the next morning you had to open with Tesla in one of the top 10 positions. It is their own fault. S&P could have included them months before, could have managed this in a much better fashion. S&P is one of the ones that will decide, because the committee that decides in which bucket Tesla belongs, consumer discretionary or sooner or later tech. S&P is one of those actors again. I hope they learned their lesson, because next time, if they wait again, it's going to be such a shift, and it's going to be so anticipated, because I remember all of us making good money in 2020 because we knew what was happening. It was written on the wall, and the same will happen again when we have that inclusion into the tech bucket.
You are such a wealth of information on this stuff. I just love having you on. This has gotten to the point where I think in part 2, we will cover Elon's the vote to restore his back pay. And we will talk about why institutional investors are so late to add it to funds where they have discretionary ability to add things that they want. I thank you so much for being on. It is so wonderful to share the screen with you, to share stages with you twice already, I think, just twice. Yeah. But I will see you again at the end of this month in San Luis Obispo for the X Takeover. Join us, won't you all? We'll be on separate panels, but we'll both be there having a great time as we do. And everybody else, what did we miss? What did we misunderstand? Leave it in the comments below, and stay tuned, stay juicy, and I cannot wait to hear from you, clever robots, in part 2.